The title of this course is Financial Management. Before we delve into the details of the techniques of financial management, it's worthwhile to discuss what the goals are and what the functions are of financial management. To start with, let's talk about how finance interacts with economics and accounting. In a sense, finance lies between economics and accounting. This can be seen in the structure of how universities position finance. In many universities, finance may be housed in its own department within a business school, for example, but in other institutions, many of which don't have business schools, finance is a component of economics and is taught as part of the economics curriculum. In other schools, finance is actually housed in the accounting department. So finance fits well with both of those disciplines. Now, the reasons for that, economics provides a structure for making decisions in various areas, and we typically think of economics as studying the use of scarce resources where there are alternative uses for those resources. What resource are we interested in finance? Well, typically money. There's usually not enough of it. Firms have multiple projects that they would like to fund, but they frequently don't have enough capital to fund everything. Likewise, shareholders and bondholders want to be paid. Bondholders have to be paid by contract. That requires money. Shareholders want to be paid dividends. What's the point of owning a stock if it's never going to generate any income? So they want income. These are drains on the cash available for the business as well. So what does the business do? Well, it may very well look to banks or other suppliers of credit or of funds. So what we're interested in finance, as it relates to economics, is we're interested in dealing with the scarcity problem that exists for cash, for money. How do we find it? How do we best deploy it, given that there are many alternative uses for the cash? Accounting, in contrast, accounting is frequently referred to as the language of business, and that language typically results in three important documents that are produced by business organizations: income statements, balance sheets, and statements of cash flow. Now, the income statement really details the profits that occur over some period of time. Balance sheets, in contrast, are concerned with the level of assets, the level of liabilities, the ownership of the firm at one point in time, typically at some year end or period end. The statement of cash flows is the more recent of these three, and it really focuses on the fact that the income statement and the balance sheet don't adequately reflect the cash flow issues that companies confront. Many companies have gone, believe it or not, many companies have gone bankrupt, not because they didn't have sufficient assets. They had more assets than liabilities, but they didn't have enough cash to meet their payroll or to pay off creditors in a timely manner. So that became an area of concern, that the cash flow situation of companies wasn't necessarily well reflected in the financial statements, and so now there's a statement of cash flows. In summary, what finance does is really links economic theory, these concerns over how to deploy scarce resources, with the language that accounting brings to us, the numbers from accounting. Now, students are frequently concerned with, well, what are the career opportunities that spring from finance? And so here there's a short listing of careers that require a strong knowledge of finance. Banker, stockbroker, these are probably well understood by most students already. financial analyst, what does a financial analyst do? Well, a financial analyst uses financial valuation methods to attach values to particular firms and thereby make determinations as to which assets might be, or firms or projects, which projects might be undertaken, which firms might be purchased, whether a firm is a good credit risk, that sort of thing. Portfolio managers are concerned with putting together bundles, referred to as a portfolio, bundles of stocks or bonds or other assets in order to minimize the risk of the overall bundle, the overall portfolio. So there's a great deal of science involved in putting together low-risk, high-return portfolios of securities, and that's the job of a portfolio manager. Investment bankers are the people who sit between corporations who need to raise money and investors who have money. In many cases, corporations know they need money, but they don't necessarily know exactly who has it or exactly what the people who have it are looking to invest in. Corporate managers really know how to run their businesses, but their business, for the most part, doesn't include on a day-to-day basis going out and raising money. Those things are done more periodically, and so they look to investment bankers to help them in that process. Investment banking has typically been viewed as a very lucrative business. Just having the contacts, knowing the right people, is sort of the job of the investment banker. Investment bankers also are involved in creating new financial products to meet the needs of corporations and of potential investors, to find better ways to match the risk preferences of investors with the opportunities that exist in corporations. Corporate finance officers are involved in running sort of day-to-day financial decisions of the corporation, picking which projects a firm might undertake, managing the cash that the firm has on hand. Likewise, financial consultants, in many cases, one of the things financial consultants may do, obviously this is a very broad range of activities, but one of the things financial consultants do is assist corporate finance officers in making those decisions. Finally, on this list, we have personal financial planners. Personal financial planner is an individual who assists investors, in particular other individuals, who want to plan for retirement, who need to insure against potential job loss or death. So they help with insurance issues. They help with borrowing, identifying what prudent borrowing is, how to go about borrowing at rates that aren't exorbitant, basically how to organize an individual's financial life. So these are all areas that require a strong knowledge of finance. Let's turn to a discussion of the development of the field of finance. At the turn of the century, finance really developed as its own discipline. The great industrialists, Carnegie, DuPont, Rockefeller, one of the elements that they mastered, which led to the development of these large, huge enterprises, was mergers and acquisitions. They understood how to raise capital and how to deploy that capital to make acquisitions, to build firms that were more valuable than the individual pieces were separately. So finance really began to develop as its own discipline during that period. In the 1930s, we were in a depression, and in that period, finance really evolved to meet the problems that arose at that time. Finance professionals were very concerned with how do we preserve capital? How do we avoid disappearing? How does the firm avoid disappearing? An important element of that is maintaining adequate liquidity, which by that we mean how do we keep enough cash on hand? Remember, this is a period when banks were closing down. So this became a significant concern. Reorganization of financially troubled firms and navigating the bankruptcy process were all important concerns of finance professionals. By the 1950s, finance began to become a little more analytical, a little less descriptive. We were concerned a little less with legal documents per se, or legal methods. At this point, the ideas really began to develop, the sort of the economics ideas, the connection to economics of how do we manage financial capital, money, and use that to make acquisitions of real capital, meaning long-term plant and equipment. Likewise, what is the best method and timing for converting real capital back into financial capital? Other issues that were addressed in the 50s were cash management and inventory management. These are disciplines that have become much more sophisticated over time, but there were models developed for how to keep the optimal amount of cash on hand. Obviously, if you keep too much cash around, cash is not an earning asset. You want to invest what cash you can, but you need enough liquidity so that you can make payroll, make purchases, that sort of thing. So there was a lot of discussion of, well, how do we figure out what the optimal amount of cash is, what the optimal amount of inventory to have around is. Walmart has become well known for how quickly they move inventory through the process, how often they're able to sell out basically their stores on an annual basis. And this has led to tremendous profitability and expansion for Walmart. In a sense, Walmart has mastered some of the important finance elements of retailing. Capital structure theory was investigated in the 1950s, and in fact, economists have won Nobel Prizes discussing capital structure theory, which really, in a nutshell, is how much debt should we have, how much equity should we have in a firm. Dividend policy was an important concern in the 1950s, and we still have. We'll still talk about that in this lesson. More recently, while we continue to be very analytic, modern finance has become much more mathematized, and the mathematics of risk and return have become very important. The capital asset pricing model was developed, and this was sort of an early effort to capture how to take into account risk in some sort of systematic, quantifiable way. Two economists won the Nobel Prize for the development of the capital asset pricing model. One of the things that is worth noting is there have been a number of Nobel Prize winners in economics that are concerned with finance. That's an area in which finance differs from other areas within the business curriculum. For example, marketing. There are no Nobel Prizes that have been awarded for marketing. Not that marketing is not important, but it hasn't developed at the same rigor that finance has to this point. There's a little more art that remains in marketing, perhaps. Although there's certainly a lot of science that's been being deployed there as well. Portfolio management was an important concern. How do we put together portfolios of assets? And again, capital structure theory. So I guess the last element that has occurred is there's been a significant development in what we refer to as derivatives. Derivatives are options, futures, forward contracts, swaps. These new financial products that really have been invented are used to hedge against risks that once we could quantify them, it became clear that it would be nice to be able to, if not eliminate the risk, to shift the risk to people who are most able to bear those risks. So these financial products have been developed with that in mind. And another concern, really this developed in the 1970s, because prior to the 1970s, we had very little experience with inflation during the first half of the 20th century, but inflation became an important issue in the 1970s. In the early 1980s, we had double-digit inflation in the U.S. Around the world, there have been economies that have had inflation that has been so destabilizing that really, literally has ruined their economies. So today, even though there's not a great deal of inflation that we see at the moment, there's a great deal of concern about what inflation may be in the future, and financial managers have to take into account the possibility that inflation will reemerge, that in fact inflation itself is a risk. In Japan, over the last decade, they've had exactly the opposite problem, which is referred to as deflation. Now, on the slide that you see here, there's reference made to disinflation. Disinflation is really just sort of an abatement of inflation, but it's not the same as deflation. Deflation occurs when the value of money really begins to rise significantly relative to other assets. So assets become much cheaper over time, not through technological innovation, but just because the value of the money is rising. Deflation creates its own set of problems. So these are all sort of issues that modern finance is concerned with. Cost of capital, that we see at the bottom of this particular slide, is concerned with what is the cost of raising money. And in its simplest form, that's what's the interest rate. Now, there's also a cost of capital for raising equity. What we pay for equity in the long run is dividends. Does equity have a cost of capital? Well, it doesn't show up on the income statement that the accountants produce, but in fact there is a cost of capital. Certainly shareholders expect to be paid something over time, and moreover, the cost of capital is actually higher than the cost of equity capital is actually higher than the cost of debt capital. Debt holders get paid first, they take less risk, therefore they're willing to accept a lower return. Equity holders get paid last, they take more risk, they need a higher return. Unfortunately, what that return isn't in the contract, so we have to infer what it is that shareholders expect from the prices that stocks trade at, that sort of thing. So modern finance is concerned about that issue. What is it that shareholders want? What's the cost of capital that they are expecting, or what's the return on capital that they're expecting? Let's turn our attention to the functions that financial managers perform. Financial management, or business finance, is concerned with managing an entity's money. In thinking about the activities that financial managers perform, let's think in terms of the balance sheet. On the left side of the balance sheet, we have assets. On the right-hand side of the balance sheet, we have liabilities and equities. Think about the left-hand side, the assets. Financial managers are involved in decisions as to how to allocate the firm's capital among the various assets. How much cash should we keep on hand? How much inventory should we keep on hand? Which pieces of equipment should we buy? So financial managers concern themselves with sort of the organization of the asset side of the balance sheet. Likewise, on the right-hand side of the balance sheet, we have liabilities and equities. Managers are concerned about finding the optimal mix of debt and equity. How much debt should the firm take on? If the firm is going to take on debt, what kind of debt should the firm take on? Should it take on bank loans? Should it take on bonds? These questions arise. What kind of debt? Likewise, the firm is concerned about how much equity, or the manager has to be concerned about how much equity the firm has. If there's not enough, the firm becomes very heavily levered and more risky. So there are incentives to not pay dividends. Having said that, the reason shareholders own companies is so that, at least in the long run, they'll receive dividends. So firms are concerned with developing sort of optimal dividend policies so that they're paying out enough in dividends to keep shareholders happy, but they're not paying out so much in dividends that they endanger the opportunities that the firm has to make more money in the future for shareholders. There's a nice figure in the text that describes the functions of financial managers in terms of the sort of daily or monthly, yearly activities that they engage in. On a daily basis, the financial managers are concerned with things like credit management. In other words, who are we going to give credit to? Which of our customers are we going to give credit to? Are there any customers we need to cut off from credit because we're in some danger that they may not pay us? It's important to give credit to those who are credit worthy and avoid giving credit to those who aren't. Likewise, inventory control. And by this we mean deciding how much inventory to have. If we have too much inventory, that's very costly. It costs money to stock the shelves. If we have too much inventory, we're incurring costs we would rather avoid. On the other hand, if we don't have enough inventory and we run out of inventory, we're going to miss some sales. So figuring out what that optimal inventory level is an important function of financial managers. Receipts and disbursements. That's this last item. Oops. Let's go back to it. This last item right here, receipts and disbursements. Those receipts and disbursements involve the company paying its bills. One of the reasons our suppliers might be willing to give us credit is we show that we're credit worthy. We pay our bills on time. If we don't pay our bills on time, we get worse terms in the future. The financial manager is responsible for making sure that the bills get paid on time. Now, on a more occasional basis, the center block here, the financial manager has to be concerned with things like stock issuances or bond issuances. Along with bond issuances might come borrowing money from the bank. These things don't occur on a day-to-day basis. In fact, the stock issuance might not occur for many, many years. However, when those things occur, the financial manager is front and center in those activities. He's also likely to bring in consultants in some cases on that when he reaches these points, because in many cases, financial managers are really good at the daily activities. They're a little less confident sometimes in the activities that only occur every few years. The capital budgeting decision is likely to be somewhat ongoing, although not daily, and by that we mean deciding which pieces of equipment we should buy, if we have alternate decisions or alternate pieces of equipment that we could acquire that are mutually exclusive, which of the two should we get? These are questions that occur on a more frequent basis, but not daily. The dividend decision may be on a quarterly basis, although some firms just pay dividends on an annual basis. All of this is done within the framework of trading off maximum potential profitability for the firm against risk. Keep in mind that the goal of the firm as a whole, of all managers, in a sense, I'll circle it over here, the goal is to maximize shareholder wealth. These are the owners. We want to maximize the wealth of the firm's owners. And doing that requires trading off maximum profitability against high levels of risk. So let's consider what that means when we talk about a trade-off, we mean we're not looking for necessarily the highest profit that's possible. If it requires taking on a great deal of risk, we might decide to forego the highest possible profit because it's not a sure thing. Likewise, financial managers aren't trying to avoid all risk. The way to avoid risk would be to just have the firm do nothing but buy government bonds. This would be a very low-risk activity, but shareholders wouldn't be very well served. That's not why they're hiring financial managers. They're hiring financial managers to assist in balancing the desire for profitability against their desire to avoid taking unnecessary risks. This trade-off that occurs between profit and risk influences the operational side of the firm. In other words, decisions about, well, should we buy a piece of equipment or should that would do the work of 10 employees, 10 men, or doing that's costing us money. If we had a recession, we can't lay off the piece of equipment, whereas we might be able to downsize our staff if we had individuals involved, or even if we're not concerned about laying off, we might be able to pay overtime to employees or cut their hours back in some way. And so having people versus capital is in many regards a lower risk activity. Capital meaning spending money on equipment. It may also involve decisions as to which product to make. Some products may have the potential for large payoffs, but there's high cost in producing them. If something goes wrong, we have big losses. So we're balancing the profit and risk objectives in our decision about what to do from an operational perspective. It also influences the financial mix. Having more equity, stock, reduces the risk of the firm relative to having more debt. If you borrow a lot of money, if the firm borrows a lot of money, that increases the risk. Having said that, the increased risk of borrowing money gives the owners, the shareholders, an opportunity to earn higher returns on the money they have invested in the company. So you can maximize your returns. The firm can maximize its returns by borrowing more, can maximize its shareholder returns by borrowing more, but it's also increasing the risks that the shareholders are facing when it does that. The finance function can be carried out through a number of different business organizational forms. The three that we're going to be most concerned with are the sole proprietorship, the partnership, and the corporation. A sole proprietorship really is just an extension of an individual's personal activities. It represents a single person ownership, and the advantages are that the owner really has very simple decision-making process. The owner just decides what he wants. It's got very low organizational forms, low operating costs, low legal costs to get the sole proprietorship started. And profits and losses are taxed to the individual owner just as part of his normal income. Now, there's a significant drawback to sole proprietorships, and that is that the sole proprietorship, because it's not a separate entity, the owner is personally liable for all of the business's liabilities. So if the business goes bankrupt, the individual is also going bankrupt. The creditors can go to the owner and take his own personal assets to satisfy any claims that they have against the sole proprietorship. Now, a second form of business organization is the partnership. It's similar to a sole proprietorship, except that there's more than one owner. It requires a little more formality. There are articles of partnership that specify what the ownership interest is of each of the partners. it describes how the profits are going to be distributed, and it describes how a partner who wants out of the partnership can get out, or how other partners can get rid of a partner. So it's a little more complex. Having said that, it also carries unlimited liability for the owners. There are entities referred to as limited partnerships. In the limited partnership, one of the partners is the general partner, and the general partner is charged with managing the partnership and has unlimited liability for the debts of the partnership. The other partners are what are referred to as limited partners. What's limited about them? Well, their liability is limited. The limited partners don't engage in day-to-day management of the partnership, but they're not on the line for losses that partnership incurs. One of the problems with limited partnership is that in many cases, for example, banks may be unwilling to lend to a limited partnership unless the limited partners promise to be held liable for a bank loan. So the lenders may very well, or people that deal with a limited partnership may very well say, we're not too concerned about whether you call yourself a limited partnership or not. Unless the limited partners agree to be liable for our debt, we're not going to loan you money. Nevertheless, there are instances where, for example, perhaps a legal claim might arise due to an accident by an employee. Well, the limited partners wouldn't be on the hook for that. So that adds some protection and limits the liability. The more pervasive, certainly most of the significant businesses in the United States are in the form of a corporation. Corporation is a unique legal entity unto itself. It's separate from its owners. There are articles of incorporation that specify the rights and limitations of the entity. The owners of the corporation enjoy limited liability. If you own stock in the Coca-Cola Company and the Coca-Cola Company does something that causes the firm to be liable to some creditor, the shareholders don't have any liability. The stock could lose all value, but the shareholders, no one can come to the shareholders and say, we want some extra money from you. The corporation has an unlimited life. Unlike a sole proprietorship that dies when the sole proprietor passes away, the corporation lives basically forever. If shareholders die, the stock is passed to their heirs, the corporation keeps on going. A key feature of the corporation is that it divides ownership interest by shares. So one individual may own more shares than another. If they wish to sell their shares, they can do so. That doesn't cause the corporation to terminate. It just changes who the owners of the corporation are. In the U.S., a significant disadvantage of corporate form is the potential for double taxation of earnings. The corporation pays taxes on its earnings, then it turns around and pays a dividend to its shareholders. The shareholders have to pay tax on the dividends. So the earnings are taxed twice, when earned by the corporation and when distributed to the shareholders. That's not an issue for partnerships and for sole proprietorships. So the tax burden is lower on sole proprietorships and partnerships than it is on corporations. With that in mind, there are a couple of entities, one called an S corporation, that is a corporation that essentially has agreed to have its shareholders pay the tax that occurs on earnings, and there is no double taxation for the most part for S corporations, sometimes referred to as a subchapter S corporation. There's also an entity more recently developed called a limited liability company, which allows it's really sort of a hybrid organizational form between the corporation, partnership, and sole proprietorship, but it has limited liability for the owners, but only one level of taxation. financial management takes place in the broader context of what we refer to as corporate governance. Perhaps to sort of clarify what we mean by corporate governance, let's start out with a short story, which is the story of Enron. Enron was one of the 10 largest corporations by market value. It was named as one of the most innovative companies in the country for 6 years in a row in Fortune magazine. And then in 2001, it turned out that Enron had been engaged in a fairly massive and systematic accounting fraud. It turned out that a great deal of the innovation was just taking place in the financial statements. At that time, the firm employed 22,000 employees. It was a very large corporation, but it ended up going bankrupt. And its accounting firm, Arthur Andersen, was indicted, and due to that indictment, which was at that time the largest accounting firm in terms of the number of clients that it had, actually was put out of business. Now, you can be sure the shareholders in Enron were not happy about what happened to the firm that they owned, not only the employees but the other shareholders. And this issue brings us to this discussion of corporate governance. And in particular here, we'll make reference to agency theory, which examines the relationships between the managers and the owners of the firm. The reason we call this agency theory is, think of a real estate agent. If an individual wants to buy a house, he might hire a real estate agent. The real estate agent works on his behalf. Within this corporate context, the owners of a firm hire managers to run the firm on their behalf. In most cases, certainly for large corporations, the owners of the corporation don't run the firm themselves. Instead, they hire someone, a manager, a board of directors. They elect these people, hire managers to run the firm. The problem is sometimes the employees, the managers, don't do exactly what the shareholders want. The Enron scandal, along with another number of other scandals, led to some changes that occurred. But one of the institutional factors that has changed over time and has sort of balanced shareholder power against the power of the entrenched management is the rise of institutional investors. And by that we mean in particular things like pension funds that own shares in corporations on behalf of the individuals who are the pensioners. These pension funds are obviously concerned about the firms acting in the best interest of the shareholders, and as large investors, these institutional investors can vote large blocks of stock and can organize among themselves to put pressure on management to do the things that the owners want the managers to do, as opposed to engaging in activities that the managers might prefer to do, such as playing more golf and jetting around on a corporate jet. So these institutional investors play an important role in regulating the managers of large multinational corporations, in regulating their activities. Having said that, as a result of Enron and some of the other scandals that occurred, Congress passed the Sarbanes-Oxley Act. Now, the Sarbanes-Oxley Act essentially set up a 5-member public company accounting oversight board who's responsible for developing auditing standards and more specifically for controlling the quality of audits, for requiring firms to have adequate internal controls, for establishing standards for the independence of auditors, and in general, the major focus of Sarbanes-Oxley is to make sure that publicly traded corporations accurately present the assets and liabilities that the firm has. having said that, it's a lot easier to pass legislation than it is to implement the legislation in ways that are appropriate. This will continue to be an issue and a concern as to whether or not the costs of Sarbanes-Oxley are warranted given the benefits that they provide. Certainly you see an instance like an Enron that's a multi-billion-dollar failure, and you know there are significant costs to inadequate corporate governance structures. Having said that, it's certainly possible that you could overinvest in monitoring of the executives of corporations, and we've actually seen a significant reduction in the number of small corporations that are publicly traded. Sarbanes-Oxley is sometimes pointed to as a reason that has occurred. Whether that's true or not is open to some debate. Another area that we're going to discuss in greater detail in this course is the role of financial markets for financial management. And when we talk about financial markets, the participants in financial markets are quite diverse. They're public government and public in the sense of publicly owned corporations, as well as private enterprises and governmental institutions that all meet together in financial markets. Various governments raise money through financial markets by borrowing, for example. And corporations also access financial markets through the issuance of bonds and bond and stocks. One of the features that financial markets allow us, let's take for example the stock market as one example, is that they allow managers of corporations to gauge how shareholders feel about and value the current activities of the corporation. Likewise, bond prices tell managers something about how the market perceives their risk level to be. So financial markets are monitored by financial executives within companies to get a better understanding of what the expectations and satisfaction level is for the various owners of debt and equity. And it may influence decisions they make. For example, if the price of issuing new debt goes up for a company, that's probably an indication that they need to reconsider large investments that they're going to make, because the cost of making those investments is going to be greater. The cost of borrowing the money is higher. So just by monitoring the cost of debt, changes are made in financial decisions within the corporation. The structure and functions of these financial markets, we really have sort of short-term and longer-term markets. Money markets deal with short-term securities that have a life of less than 1 year. The large corporations sell commercial paper that is used to finance daily operations in these money markets. Likewise, certificates of deposit or CDs with maturities of less than 12 months are issued by banks. Governments, the U.S. government issues 13-week Treasury securities, raising money in these short-term markets. There are also longer-term markets. We refer to these as capital markets as opposed to money markets. The capital markets are defined as those where securities have a life of more than a year. Among the markets that are included in capital markets are markets for common stock and for preferred stock, as well as the bond market for both corporate and government bonds. These markets are important institutions of capitalism in that they are the mechanisms by which principal mechanisms by which capital is allocated to the parties who are best able to use the capital. So a company that has a good opportunity can raise money through the capital markets, whereas a company that is wasteful would find it very, very expensive to raise capital because parties would be unwilling to, investors would be unwilling to supply that capital to those companies. So the mechanism by which capital is raised by companies is through what's referred to as the primary market. So when the corporation uses the financial markets to raise new funds, these are done through what is referred to as the primary market. So let's say they issue stock. Now, after they issue stock, shareholders buy and sell that stock, not with the corporation, but among themselves. And that's referred to as a secondary market. So the secondary market occurs for stocks that have already been issued. You know, as an analogy, you might think of a monopoly game. In the game of Monopoly, when you land on a particular piece of property, you can buy the property from the bank. After that, people can trade those little pieces of paper among themselves in the game. They're, for the most part, not sold back to the bank. So there's a secondary market, in essence, that arises of people trading those monopoly properties among themselves rather than the primary market where someone buys it initially from the bank in that case. Well, in the case of companies, they issue their stock initially. After that, there's a lot of buying and selling that takes place among the trading, the investing public in the secondary market. It's worthwhile to recognize that there's been a significant internationalization of financial markets. That allows U.S. investors to invest in companies and in governments abroad. If you want to buy a Japanese bond, you can do that here in the United States. Likewise, a great deal of stocks and bonds sold in the United States are owned by governments and by individuals in foreign countries. That's had a significant impact on corporations, in particular large corporations now find a need for financial managers to understand international capital flows. And they need to understand how to trade foreign currencies. They need to understand hedging strategies for those foreign currencies. So the internationalization of financial markets has led to a need for greater sophistication on the part of financial managers.